Want to grow your money but don't know where to start? Let's break down mutual funds in the simplest way possible. What are mutual funds? Mutual funds are investment vehicles that pool money from multiple investors and invest it in a diversified portfolio. This portfolio can include equities, stocks, debt instruments like bonds and debentures, money market instruments, and other securities. Mutual funds are managed by professional fund managers under an asset management company, AMC. Three reasons why should you invest in mutual funds? 1. Diversification. 2. Professional management. 3. Affordable investment. When it comes to investing in mutual funds, there are two popular methods, SIP and lump sum. SIP stands for Systematic Investment Plan. In this method, you invest a fixed amount regularly. For example, 1000 or 5000 rupees every month. It helps you build a disciplined investing habit and removes the need to time the market. One of the biggest advantages of SIP is something called rupee cost averaging. This means when the market is down, you buy more units, and when the market is up, you buy fewer units. Over time, this helps reduce your average cost of investment. Now let's talk about lump sum. In this method, you invest a large amount of money all at once, like 50,000 or even 1 lakh rupees. Lump sum works best when the market is low because you get more units at a lower price. However, if the market falls after you invest, the risk is higher. So, which one should you choose? If you earn regularly and want to reduce risk, SIP is usually the better option. But if you have a large amount ready and see a good market opportunity, lump sum can work well. Now, let's understand how mutual funds work. You invest 10,000 rupees in a mutual fund. That money is pooled with other investors. A fund manager invests it in stocks and bonds. You receive units of the fund. If initial value equals 10 rupees per unit, then you get 1000 units. Later, if value becomes 12 rupees per unit, your investment becomes 12,000 rupees. When you invest, you don't directly own the individual investments. Instead, you own units or shares of the mutual fund. The value of each unit is called the net asset value, NAV. NAV equals total value of funds investments minus expenses divided by number of units. There are different types of mutual funds depending on where your money is invested. 1. Equity mutual funds. 2. Debt mutual funds. 3. Balanced/hybrid mutual funds. 4. Index funds. Equity mutual funds invest mainly in company shares. They have higher risk, but also the potential for higher returns over the long term. Debt funds invest in bonds and government securities. They are generally safer, but offer lower returns compared to equity funds. Balanced/hybrid mutual funds combine both equity and debt to balance risk and return. They are great for moderate risk investors. Index mutual funds are a simple and low-cost way to invest in the stock market. Instead of trying to beat the market, these funds simply copy a market index, like the Nifty 50 or Sensex. That means they invest in the same companies, in the same proportion. Risks of mutual funds. 1. No guaranteed returns. Mutual fund returns are not guaranteed as market movements are unpredictable. 2. Dilemma of choosing the right scheme. There are over 4,000 mutual fund schemes in India. This makes it difficult for investors to choose the right one according to their goals and risk appetite. 3. Mutual fund charges. High expense ratios and other management fees and costs can reduce overall net returns. Start small and stay consistent. This video is for educational purposes only. I am not a financial advisor. Mutual fund investments are subject to market risks.